In Chapter 2, we're going to learn about financial markets and institutions. And the major learning objectives for this chapter are for you to be able to identify the different types of financial markets and financial institutions and explain how these markets and institutions enhance capital allocation, and for you to explain how the stock market operates and list the distinctions between the different types of stock markets, for you to explain how the stock market has performed in recent years, and for you to discuss the importance of market efficiency and explain why some markets are more efficient than others. And then we're just going to develop a simple or basic understanding of behavioral finance. So the first thing that we should look at is how is capital transferred between the savers and the borrowers? Well, we have three things: the direct transfers, investment banks, and financial intermediaries. For the first one, in a direct transfer, a business sells its stocks or bonds directly to the investors, and those people would be the savers. So they sell directly to investors without going through any type of institution. The business borrower receives dollars from the savers, and the savers receive securities like bonds or stocks in return for their money. If the transfer is made through an investment bank, the investment bank serves as a middleman. The business sells its securities to the investment bank, and then they sell them to the savers. Although the securities are really sold twice in this situation, the two sales really just make up one complete transaction in the primary market, because this is the market where companies are raising new capital. If the transfer is made through a financial intermediary, then savers invest funds with the intermediary, which then issues its own securities in exchange. Banks are one type of intermediary where they receive dollars from many small savers and then lend those dollars to borrowers to purchase homes, cars, vacations, and so on. And also they make loans to businesses and government units. The savers receive a certificate of deposit, like a CD, or some other instrument in exchange for the funds deposited with the bank. Now, right now, if you're saving money in a bank, you're making a very, very low rate of return, like 0.2%, so it's kind of sad. But then mutual funds, insurance companies, and pension funds are also other types of intermediaries. So the capital allocation process, what needs to occur is that you have people with excess money, and those are like individuals like us or corporations, and they're looking for some type of an investment and hoping for a specific rate of return. And then you have people that need money. Well, really, they're companies that need money, but it could be an individual. And so they need money to finance some kind of investment opportunity. It may be that a company needs to invest in some equipment to make more of the product that they're currently making. And so those people or demanders for capital, they're willing to pay a certain rate of return on the amount of money that they borrow. So you just have supply and demand forces working here.